So, good morning, good afternoon, and good evening, wherever you are in the world. I am Ross Burland for FXStreet, and I'm joined today by Yohay from Forex Crunch. Good morning, Yohay.
Morning, Ross.
And also Dent. So, the idea of today's panel is going to be a fundamental analysis to help us try and understand what may or may not come of the new year and further ahead, in fact. It's looking to me as clear as mud. There are many uncertainties, a lot of risks for financial markets. So let's get cracking. Harry, could we start by just talking a little bit about your background? And I think no better place to start than your new book.
Well, first of all, I'm called an economist, but I didn't start that way. I took economics in college, majored in it at first, then gave up. I thought it was kind of mostly useless what they were teaching, and nobody could understand it. So I studied business, went to Harvard Business School, came out, was a consultant to Fortune 100 companies for a few years at Bain & Company. And I like more innovative companies, so I started consulting to new ventures in California. And out of that learning there in business and cycles in business and studying the baby boomers for my new venture clients back in the early 80s, I started to see the importance of demographics in a wealthier world where the middle class mattered much more than it did, centuries ago. And so I came up basically with a whole new theory of economics, demographics, other key cycles that affect productivity and the geopolitical environment. And I've just been building those over years. My first book came out in 1989 when I started my newsletter then. I was largely lecturing to small business CEOs around the world through a company called Now Visage. It was tech back then. And it was just a self-published book as a handout. But in that book, 1989 published, we predicted in the 90s, Japan would have a 12 to 14 year major crash and downfall, a long-term peak in their economy, while the US and Europe and the rest of the world would see the greatest boom in history, greater than the Roaring '20s. And my second book came out in 1993, right after the recession, which we also predicted would happen, and said, hey, man, Dow 10,000 by 2000, we're getting ready to hit that great boom after this recession. And that happened. And then next thing I know, I'm an economist and I'm lecturing to stockbrokers and financial advisors around the world. Now they don't like me so much because our latest books have been, we were very bullish because of the massive baby boom generation and the rise of new technologies like the internet and personal computing into the mainstream, much like autos and electricity and phones back in the early 1900s and Roaring '20s. And but every boom ends. And so, obviously in the last decade, I've been warning about, hey, we've got a downturn coming. The baby boomers are done. The internet has peaked. Everybody's got the internet. And now we're down to Facebook with dancing dogs and cats and stuff, instead of breakthrough innovations like email and Google. So I've been bearish. Yeah, I came out with the Great Depression ahead in 2008, and books, the demographic cliff, I think was early 2014, showing that, hey, what happened in Japan then happened in the US with a peak in demographics, and it's going to happen in more and more countries around the world, such that all this, quantitative easing and stimulus is fighting a tidal wave against it, and it will not succeed at a point, and I think it's already failing. So that's my history, and I just came out with this new book, The Sale of a Lifetime. We self-published it for our own newsletter subscribers, and it's coming out with my publisher in early January, and this is focusing more on bubbles, why we don't see bubbles, why they're clear as a bell. Walk like a bubble, quack like a bubble, and people don't see them because they're on a high, they're getting something for nothing, but you can measure and predict bubbles. I hate the word black swans. There are no black swans. If something looks like a black swan, then there's a cycle happening that you didn't see and now is turning the other way. So that's a brief introduction for me.
Okay, fantastic. Well, that will bring us there to a recent Federal Reserve hiking interest rates, and we just had a pre-discussion before this live event. But Yohay, I mean, we saw that the market had been predicting this. A lot of it has been priced in. I'd like to now look at what the effects of that might be initially. Do you think there will be initial effects just from that very slight increase of rates? Or do you think, for instance, Trump is going to be the next major catalyst?
I think Trump is the major unknown, the main catalyst. I mean, we don't really know what he's going to do, at least at the beginning. So, and he's one of the reasons. I mean, if he introduces fiscal stimulus, tax cuts, and infrastructure spending like markets believe now, and markets have gotten a bit ahead of themselves, then the Fed is going to raise rates even more. So, and if he's going to do less, the Fed is going to do less as well. So I think Trump is the main focus for the Fed. I don't see 3 rate hikes coming. I think 3 is the maximum. It's a cap, sort of the upper limit. 2 seems more likely, perhaps the first one coming in June, after the first 100 days of the Trump administration, and the second one in December. But if the economy doesn't do so well because of Trump, or thanks to Trump, or regardless of Trump, and if the dollar is too strong, hitting emerging markets, and that would hit the US back, or dampening inflation, then another repeat of 2015 or 2016 with just 1 rate hike is also a scenario. So I see either 2 rate hikes as my baseline, 3 is if everything really goes well, and 1 is also a possibility if things go well.
There are corporate tax cuts, fiscal ease, trade policy, okay? So, you know, bearing all those 3 things in mind, I mean, we can be skeptical of such a scenario as they factored into their dot plot of 3 hikes and this sort of aggressive turn towards increasing rates. I mean, the implementation of any of these policies, I mean, there's going to be a lag of infrastructure spending, and that can be considerable. So finding shovel-ready projects are going to be a challenge. So, I mean, there's going to be a huge delay in this, don't you think, Carrie?
Yeah, there's a huge delay. Especially it takes forever for these things to hit. And my thing is that tax cuts won't work to expand capacity and jobs because corporations have already had free money courtesy of quantitative easing and 0 interest rates adjusted for inflation. And all they've done with that low-cost financing is buy back their own stocks and generate mergers and acquisitions. They're not expanding the pie because we already did that in the bubble boom. Companies overexpanded, overborrowed, consumers overbought and overborrowed, especially in housing. And now there's no way to expand, and this will just give the top 1% in companies more profits. I mean, more net profits after tax, but it's not going to expand the economy. So, you know, another thing I tell people, this is my biggest argument, just simply demographics. Japan hit this demographic peak back in 1996 and has had quantitative easing nonstop escalating ever since. They're still growing at 0 on average with 0 productivity and near 0 inflation. You can't grow 3 to 4% as they're promising in a aging economy and society like we have in the US and in Japan and Europe, and we're the best house in a bad neighborhood. So that's another reason this is not going to work. And also productivity. So I mean, workforce growth is going to be negative for the next several years. Population growth is going to be barely positive, 0.27%. That's near 0 for the next several decades. And workforce growth is going to be slightly negative for the next several decades. So the only way you can grow is productivity. We'd have to have 3 to 4% productivity. But guess what? Productivity has dropped like a rock in recent years. Because aging societies don't get more productive. Young people enter the workforce and get more productive. But after their late 40s, early 50s, people get less productive and they start dropping out of the workforce and retiring. So there's no way we can grow 3 to 4% growth sustainable. And who are you going to build infrastructures for? I'm getting older. You know how much I drive? A month, 300 to 400 miles now, sitting in downtown San Juan where I can walk almost everywhere. And I work out of my home. And someday I'll retire, probably not for a long time, but older people don't need more infrastructures. They don't need bigger houses. They pay down debt. They downsize their housing and infrastructures. So this is a fairy tale, and Republicans are proposing a Ronald Reagan strategy coming out of the inflationary demand, demand insufficient economy in a time where we have excess demand. What we really need to do is reorganize debt and take these debt burdens off of our economy so we can grow to some degree in a slowing economy where there's going to be more retirees, less younger people, and there's no way to grow like this. So I think what's going to happen in 2017, all these promises have been made. And like Yohay said, to the degree he ups fiscal stimulus, now that monetary stimulus is not working, especially in Europe and Japan, going to extremes, the Fed's only going to have to offset them with higher rates. So I don't see how this happens. I think Trump got in from the dissatisfaction of the declining middle class and the all-star wrestling fans, I call them, who aren't doing well in this globalization economy, and globalization's peaking as well. And I think the economy's going to realize, and the market's going to realize sometime in 2017, this ain't going to happen. And they have priced in this 4% growth and only modest Fed hikes, and they're just going to be wrong about this, I think.
Yeah, I mean, on that point, I mean, talking about recessions, right? So, I mean, historically, that they come every, 4 to 7 years. The US is already in the 4th longest economic expansion in US history. You know, and by the time Trump is actually sworn in, I think it's actually going to be the 3rd longest expansion. Yet we've got, you know, the Dow coming up to the psychological level there. A lot of hysteria around Trump. Do you think this is going to blow up in everyone's faces, Yohay, next year?
Well, hopefully nothing will blow up too soon. But the factors that Harry mentioned are certainly worrying. Demographics, the retirement of the baby boomers, the exhaustion of ammunition by monetary policy. So in the US, one of the reasons for rate hikes is getting ready for the next recession, not having to raise rates too abruptly, and doing it that when we get the next recession, they can cut rates a bit. So yeah, things are not moving too fast. I want to be optimistic. Optimism comes from maybe, well, in the US, hopefully Trump will not be so harsh on immigration, and demographics maybe could improve. I mean, there's contrast between campaign promises and what politicians actually do. And maybe a new wave of automation will come, but this will probably take more time for all those sci-fi movies to become reality, self-driving cars and things like that. So maybe another delay, maybe another extend and pretend like they did with Greece will happen in the US for 2017. Maybe the falling off a cliff could be postponed, but we'll see.
Well, I mean, to me, you know, you can't go from sort of ground zero where we've been at with, you know, sort of reckless. I mean, initially the Fed, you know, had to do what they did, but you know, QE2 never worked, and it was kind of reckless policy thereafter. But how can we go from that ground zero to all of a sudden pink clouds without anyone bearing any pain in between? Because I mean, that's what the market is looking like at the moment. When you look at these markets, you look at the dollar. I mean, the dollar's got a fundamental case besides, because there's a huge shortage. I mean, it was BIS that came out recently and said that there's about $10 trillion, you know, shortage in the world. So, and that's self-explanatory when rates start to go up and everyone's scrambling to cash in on that. So, but how can we go from ground zero to pink clouds all of a sudden and no one bearing any pain? I mean, it just doesn't make any sense to me. So, I mean, that's where I'm coming from. I'm not as optimistic as yourself there, Yohay. I mean, or perhaps you were just saying you'd like to be, but it just
I'd like
doesn't
to
make
be,
sense.
I think it will not happen. Maybe not in 2017, but yeah, either to get an improvement, as Harry mentioned, this global debt issue, also in the United States, all the deleveraging is still happening quite severely, at least here in Europe, that someone will have to pay the price with this big reset of debt. So, but I just think it won't happen in 2017. I think there will be another extended pretend.
Okay. So essentially, we're agreeing that we think rate rises are going to hurt borrowers. That eventually they're going to hurt the banks. I mean, at the moment the financials are doing really, really well, but I think the elephant in the room that people are missing is that you know, if interest rates are on the rise and banks think that's a good thing for them when it comes to lending, Well, guess what? You're going to have all these borrowers that actually can't afford anymore the repayments, or whether it's on, you know, a bubble in the auto industry or the property market, and there could be a big fallout there. You know, with inflation on the rise. I mean, and inflation is not a good thing. You know, but central banks want inflation, but, you know, why is that a good thing, Harry?
Well, it's not short term. They want inflation because they fear deflation more. Deflation is what you get in times like the Great Depression, when, as Yohay was just saying, you're going through debt deleveraging, and debt deleveraging also causes financial asset bubbles like stocks and real estate and commodities to collapse, because financial asset bubbles build every time you get debt bubbles. People don't realize that debt, just for example, in the United States, since 1983, total debt, government and private, has grown 2.6 times GDP for 26 years into 2008, before we hit a peak in the debt bubble. And since then, we've added more debt, especially in emerging countries, another 57 trillion to the world. I mean, we're in a time where debt's just out of control, and that's one of the big hurdles. Are you seeing my slides?
Yeah.
Okay, this is a graph that says, look, here's how much financial assets there are: bonds, loans, stocks in the world. And this is a dated graph from a study a couple years ago. It's over 300 trillion, and that is more than 4 times the entire global GDP. And that's more than twice as high as it's ever been in any time in history. We've got a massive debt and financial asset bubble. And what happened in the 30s is a lot of those debts and financial assets deleveraged and disappeared. Not for a cycle, not for a few years, and you go back to new highs. Stocks peaked in 1929 and didn't get back to those highs until 1953. 24 years later. Real estate went down, didn't get back to the highs for another 10 years, and in the bubbly cities like New York, it took 25 years. So we're getting ready to see a big reset. All of this quantitative easing, pushing money into the bank system, putting money free so people will at least speculate, and at least their home loans and car loans will go down, is only been staving off this debt deleveraging. Banks have not been forced to write down their loans, their zombie loans. Just keep them on the books and hope the economy gets better. And then when the economy gets better, you won't have to write them down 8 years from now. Not going to happen. Real estate is never coming back to the highs we've seen. It hasn't in Japan since its peak in 1991, on a perfect 42-year lag for peak home buying, with their baby boom generation ahead of the rest of the world. Hasn't come back, and it's still on its bottom, down 67%, 25 years later. It's not coming back because there's more older people, who are sellers, by the way, dying than younger people coming along and buying. And the young people, like the millennials here, don't feel as secure in a bad economy, and they've seen real estate go down. So this is the big thing that they're trying to prevent. And if I go back a couple slides real quick, my biggest innovation back in the late 80s, which allowed us to see the Japan crash and the boom in Europe and the United States, I just look at when new generations spend the most money, 46-year lag in the US, 47-year in Europe and Japan, and we get these generational waves, the blue background in this chart, which lets us see the economy almost 5 decades in advance. We predicted in the late 80s that Japan was going to collapse then. We predicted the US would hit its peak in 2007, and Europe a few years later in 2011, and that's when they started having their crisis after the US subprime crisis. So demographic trends continue to work against the economy. In the US, we don't turn up again with the next generation till 2023. In most of Europe, there is not much of a millennial generation to bring the economies back. And guess who has the worst demographics of any country in the world after Japan, and looks just like Japan in the late 80s? Germany, who's supposed to hold up the EU. One more graph that's important. I have 4 major cycles that I've honed since my demographic cycle, the most powerful in the late 80s. A geopolitical cycle that's favorable for 17 to 18 years, and then not. And that started in 2001, 9/11. This cycle continues down until 2020. Then it starts to turn up. So we're going to see more of this terrorism, failed wars, civil wars, revolts against police brutality, revolts against the rich. And again, that's something Trump is playing on. 45-year innovation cycle. There's always innovation, but there's times when major clusters like cars, electricity, and phones together move into the mainstream and really change the productivity of workers and companies. And those like steamships peaked 1875, railroads 1920, automobiles 65, and the internet recently around 2010. And then those innovations are not as favorable. That's why we're sitting at zero productivity. That cycle has peaked as well. And then finally, we have every 10 years, a decennial cycle, stock markets see bigger crashes and recessions, and we're in such a down cycle. The point here of this graph, probably my most important graph, all four of the cycles I found that really matter, because there's an infinite number of cycles, all four point down at the same time into early 2020 before some of them start to turn up. So the next 3 years is the most dangerous since the early to mid 70s when we had our last major financial crisis, and before that 1930 to 34 when we had the largest crisis in US history. I think the next 3 years are going to be the worst anybody will see in their lifetime. And as I'm saying before, all of this massive, unprecedented, desperate quantitative easing and now desperate fiscal stimulus, which can't work after you've overexpanded an economy, as I said earlier, is going to finally fail. And we're going to have this debt deleveraging. And that's one reason I'm sitting in Puerto Rico. This is a bankrupt country, but they've been slowing for 10 years. They don't have civil unrest, and the weather's good here, and the people are pretty darn happy. I'm going to sit here and watch this fiasco from Puerto Rico the next year. I think the next 3 years are the worst we're going to see.
I'm in Spain also, 20% unemployment, and people still go out and smile and try to be positive, and the weather is great as well. So, sorry, Ross.
No, that's fine. So we're in a situation here. Are we in agreement that globalization is in decline as well? Because that really starts to make things complicated.
Hey, let me kick in here real quick. I mean, this is something I've really dug into with this Trump thing and Brexit and the Italian vote. This is a global phenomenon. I track globalization all the way back to Christopher Columbus. There's somebody that did that analysis, thank God, as a percentage of global trade. It really surged for the first time with steamships in the mid to late 1800s and peaked with World War I. When World War I came along and then the Great Depression and World War II, of course, people didn't trust each other. The world was in turmoil, and global trade went from 40% of GDP, and they're double counting because they're counting imports and exports, but 40% to 10%. That's a massive decline, and it took 33 years. Well, we surged even stronger with jet travel and the internet and computing and all this stuff. I mean, and now we've had the greatest surge in globalization ever. And you know what people are saying? Hey, it was good in the 50s, 60s, 70s, and 80s, but you know what? More and more people are saying it doesn't work. It's favored Asia, it's favored Mexico, but we in Europe and US, we are sucking wind, especially the middle class and lower classes. And there is a revolt against globalization. I think it has peaked. I think this is going to slow down for decades before we realign the world economy around cultural, ethnic, financial, kind of natural groupings. I mean, Europe is extremely split from north to south and west to east in lifestyle and incomes and stuff. Even northern Italy is double the incomes or GDP per capita of southern. The United States has the red states versus the blue states. I'm telling you, the blue states are going to start leaving the United States with a Trump America, because basically the red states have taken over. So I think that globalization peak is another major factor, and it may be good in some ways for countries to pull back and protect themselves, but overall it's a declining pie, and it's bad. And the Great Depression was marked by a tariff war, and now we have trade wars, and we're using quantitative easing to push down currencies and cheat. And now Trump is going to start probably a tariff war. So this is not a good sign.
So when you take that and then put it in the context of Trump's protectionist policies, when we've already got, as I mentioned there, the biz were coming out and saying $10 trillion shortfall in dollars out there in the offshore market. So with Trump's protectionist policies, that's going to mean less global trade and even less dollars in the offshore banking arena. So that is a case for a stronger dollar, is it not? But then coupled with our bearish outlook on the US economy and potential quantitative easing, whether that comes in, I mean, when do we think that could kick in? Could it kick in next year or further out?
In the US, I don't think it'll kick in next year. No.
Go ahead, Yohay.
Sorry. I said in the US, I don't think more quantitative easing will kick in next year. I think the Fed will still on the path to raise rates, and well, things could go sour. Things could get much worse, as you described, but I don't think it'll happen in 2017. Regarding Trump's trade wars, I think part of it is campaign rhetoric, and I don't think he'll implement everything he said. Okay, TPP was controversial anyway, and it didn't include a lot of tariff reduction, more related to intellectual property, environmental defense, things like that. So apart from TPP, I think, well, it's going to be more Republican pro-trade administration than isolation one. I mean, it's going to be somewhere in the middle, of course, nothing too extreme, but I think it'll lean more towards, I don't think it'll be that bad like we heard in the campaign. So I do agree that globalization has peaked. It's not only Brexit and Trump, it's also what we've seen in growth figures. The global growth exceeds the growth in trade, I think for the first time in 15 years this year, and that's of course telling that peak globalization is already reality, not just rhetoric. But I don't think we'll see a crash in globalization, a total isolation of the United States, or I think there will be an effort to continue maintaining relatively high levels of trade, which will benefit everybody. Again, this is the optimistic view, at least for 2017.
You know, Ross,
Okay.
Here I have to disagree. I think there is going to be a sharp contraction in the economy. That only feeds greater isolation and separatist policies and protectionist policies. Again, exactly what happened in the Great Depression. And it only makes, yeah, everybody seems to benefit short term from protecting some jobs or protecting some industries, but everybody retaliates and the pie keeps getting smaller. If you take away global trade from what's happening, I mean, export industries are countries' most profitable industries, and that's what you're losing to protect your weaker industries. So it's not a good trade-off. Two things that are happening. You look at the last crisis in 2008 and 9, guess what rallied when everything went down at the worst of the crisis in the second half of 2008? U.S. Treasury bonds, and also high-quality bonds in Europe, and the U.S. dollar. The U.S. dollar is the safe haven. We're not responsible fiscally or monetarily, but we're the best house in a bad neighborhood. We haven't done as much quantitative easing nearly as Japan, and we've done less than Europe, and we're not doing it now. Our demographics are not as weak, even though they're weakening dramatically, as Europe, and Europe's not as weak as Japan. And so we're the best house in a bad neighborhood, and we're the reserve currency. We've been predicting the dollar's been trading in a trading range from 93 to 101 for 2 years, and it was going to break out. Well, it just broke out to 102 recently. Next target is 120. That means the euro goes to 0.85. That means the Australian dollar goes in the low 60s, which I've been predicting, both of those for a long time. The dollar is like tightening credit around the world because a lot of countries, especially emerging countries, borrow in US dollars. The dollar goes up. The cost of those loans and paying them back goes up. That's a tightening impact. The other thing is we've been predicting that Treasury bond rates, even in the best house in a bad neighborhood in the United States, would spike in the early stage of the next crisis, which is another reason I think this is happening, because the bond bubble trade would reverse. I mean, traders have been piling in, just betting on central banks continuing to do as they pledge and buy up their own sovereign bonds, and they just buy futures ahead of them, and you get a free lunch on leverage with low cost, with a near zero cost carry trade. This is the free lunch of all time. Well, no free lunch lasts forever. And now that late stage inflation is setting in, as we predicted, Trump is coming in and saying fiscal stimulus, build infrastructures, run deficits. Now bond rates are rising. They were already rising months before the election. They started to rise since, I think, early July. Trump accelerated that. We've been predicting the 10-year Treasury is going to go to 3% or a little bit higher. And if it breaks above that, where there's extremely strong long-term resistance, then we're really dead. But rising rates are not good for global borrowing, not good for mortgage loans and real estate, and certainly not good for stock valuations. In the early stage, they say, oh, they're rising because we're going to grow. So that's not so bad. But stocks are valued at their projected earnings, which aren't so strong anymore, and discounted by the 10-year Treasury bond rate, say in the United States. The higher that rate, the less those earnings are worth in present day value, and stock valuations are not going to like rates at 3% or higher. And I think we're going to see that within months. So I think a rising dollar, rising sovereign bond rates, and this is happening in Europe as well, are going to be another trigger. The Italian default, which is just imminent at some point in coming months. I think you're going to have actually a dramatic downturn, and that is going to increase protectionism. I would agree with Yohay, if it weren't for all these kind of factors, yes, it would be natural. And yes, the Republican Party, the mainstream, is pro-trade, but Trump just kicked their ass with an anti-trade and protectionist policy and took over the damn party. So they're going to have a hard time fighting around this. Trump does want less trade and does want protectionism.
Yeah, I mean, you know, the recent rise in the greenback and a spike an exodus from emerging markets. You know, and as you said there, I think that's a trend that is likely to continue playing out in the coming year. It's just a question of, I mean, we're getting into currency wars here, and the only way to win a currency war is by not being in one. And this thing's just going to self-implode, correct?
Yeah. I agree with that. I mean, but that's what everybody's doing. And actually, the United States is the only one that's not. That's why our dollar's been stronger. Japan now has their cumulative balance sheet, or quantitative easing, is 95% of their GDP. In Europe, it's 34%. And in the United States, I think it's 24 or 26%. Again, we're the best house in a bad neighborhood. But there is this currency war, and Japan is the one leading it. And despite being so aggressive, their economy keeps stalling, falling in and out of recession. They keep falling back towards zero inflation. And their productivity has been zero forever, as ours is going to be, and Europe's going to be in years ahead. It's a short-term solution to a long-term problem. Debt restructuring is the #1 way to position an economy to grow again, even with weak demographics. Raising retirement ages is another way. We've aged 10 years longer on average for dying since we started all these entitlements programs in the Western world, and yet we're still retiring at the same age. People stay in the workforce longer, contribute more, and take less, and that's another way to fix this. But you're not going to get people to have more babies, especially in a risky time. So you have to restructure the bubbles in debt and financial assets that are only making the 1% richer and the everyday person fall behind, and are only creating bubbles that are going to burst even harder the longer you keep them up. So there is no easy way. There is no bridge over troubled water, but there's a more civilized way to do this. Rather than being in denial and just printing money and then going to fiscal stimulus, building stuff for nobody, which China's going to have the biggest bust in the world because they've been building stuff for nobody 10 times anybody ever has. Watch that for the next 2 years. When China goes, that's going to be the worst. But you can't have short-term solutions. You can't take more of a drug and expect things to work out well. That's what we're saying. And that's what governments are doing. Fix the problem. Deal with the debt. Restructure. Don't cut taxes. Raise taxes, especially in the more affluent, to balance budgets again, because you can't keep running deficits forever.
Okay, so we're in agreement that things are not looking good. There's nothing too positive out there. We're moving into a year when we have an awful lot of political risk ahead of us. We have the French presidential election. We also have the German parliamentary election. We also have a general election in the Netherlands. We've already agreed that there's a lot of populism coming around. What do you think could be the next major risk for 2017? Will it be the politics? Will it be interest rates going up? Could it be the default of an Italian bank or Deutsche Bank? What do we think, Yohay?
I think the focus has moved a bit away from central banks and into politics. It's the French elections are the most important ones because there's a real chance that Marine Le Pen will become the French president. In the Netherlands, there will probably be some kind of a mainstream coalition. In Germany, I think that Merkel does have the upper hand, and that's only later up this year. French elections are the big unknown. And the second thing is, of course, what will Trump actually do? And I think that influences the Fed more than anything else. So I think we're going to be talking a lot more I mean, in 2016, we already talked a lot more about politics, the run-up to Brexit, the implications, and then the run-up to the US elections and the implications. I think this trend of politics trumping central banks will continue. Central banks seem to be the only game in town, especially here in Europe, for quite some time. And I think now the ball sort of is in the politicians' hands worldwide, and these are risks. Of course, there's also other political risks, geopolitical risks. The war in Syria now tilts towards the regime, but I don't see an end coming to that, and that might still spill over to other places. In South Korea, they just impeached or suspended the president. There's going to be a new president over there, and the North Koreans would like to test South Korea when they have a new president. And with Trump, at least according to campaign rhetoric, sort of moving away from intervention, especially while talking about South Korea and Japan having to take care of themselves. So that could be also another risk. Things that are currently in the back burner, also Greece is in the back burner. Bigger risks, again, top risks for me. French presidential elections, the end of April, and Trump from January 20th, the inauguration, and, well, throughout the year, but especially his actions on day one and his first 100 days, sort of, that's what the media focuses on. So and that's what moves markets as well.
Yeah, okay. And in terms of the banking crisis over in Italy and Europe, Harry, what's your take on that? How close do you think we could be to a global impact? I mean, if one of these banks goes down in Italy, or I mean, if Deutsche goes down, I mean, what is the effect of that? And is it really going to be something that's going to come to fruition soon, do you think?
Yeah, I do think so, and the stocks of these banks are reflecting it. I agree, you know, with that you know, the political environment's only going to get worse and more testy. But look, we've already seen Brexit. What do the markets do? Go up. Already seen Trump. Thought it's going to be bad. Go up. We just seen the Italian election. No, supposed to be bad. Goes up. So that's not going to kill the markets. The markets are on crack. They're on a high. They want to go up. There's nowhere for people's money to go. It's going to take something real, like a major bank going down. So that's what I put. I think China is the biggest risk and impact down the road, because their bubble and overbuilding and real estate bubble is beyond anything in all of modern history. And I've studied modern history in depth. But all you need is one big trigger, like the subprime crisis in the United States. People don't realize that was 4 states: California, Arizona, Nevada, Florida. Most of that 4 states. And next thing you know, you got a worldwide stock collapse and recessions and banking and debt problems around the world. It was just a trigger for a debt crisis and a demographic crisis already in motion. So I think, I've been saying, the most likely trigger in the first half of 2017 is an Italian default or a Deutsche Bank default, and a whole thing about, are we going to bail them out or not? Is Merkel going to bail them out? Is Germany going to bail out? And the you know, Eurozone going to bail out Italy? And I think, no, yeah, Merkel will probably have to bail out Deutsche Bank at some point, begrudgingly. And Italy will have to bail out their banks begrudgingly, but Italy doesn't have the firepower to do it. So I think when the markets see that, okay, that's what, you know, that's the reality for the crack addict. Okay, you can't just keep taking more crack here. You can't. Quantitative easing isn't going to offset that sort of crisis. And even if they do start to ease again in Europe, United States, and elsewhere, they're going to be on a lag. In the European politicians, especially Merkel, are going to fight this at first. Nobody wants to set a precedent for bailouts for Deutsche Bank or Italy. And of course, Greece never has gotten out of its crisis, or Cyprus, and Portugal's right behind them, and Spain's right behind them. And like you say, Germany is growing against, you know, bailing out. France is growing against the Eurozone. So is Italy. I mean, sooner or later, the euro is going to blow. I don't see any way around it. And I think in the United States, we got a different problem where I said earlier, I think major blue state blocks like the West Coast are going to say, we can't live in Trump America with these super conservative socialist policies and separatism and anti-trade and tariffs and stuff. Hey, Silicon Valley wants to trade with Asia, damn it. And I think they're going to have to break up. I think we could have some sort of civil breakup in the United States and stuff. So I think there's major stuff coming. All I keep warning, Ross, is that my long-term indicators, and of course increasing short-term indicators, say the next 3 years is likely to be the worst 3 years for the economy since 1930 to 33. That's what my indicators are telling me, and they're rarely wrong. They can be early or something, but they're rarely wrong, and they're, like I showed earlier, they're all pointing down. There is, to me, there's no soft landing out of this, and the one country that has no chance of a soft landing at some point is China. They are so overbuilt. They don't need to build another anything, infrastructure, housing, offices, malls, railways, anything for the next 12 years, even if they continue to urbanize as fast as they're urbanizing. And people didn't notice, in 2015, for the first time, rural migrants into the cities there, illegal, unregistered rural migrants, actually went back home and reversed the trend. China's used to be building stuff for future people coming into cities. Now there's really nobody coming into cities, and their bubble's going to burst. So I do not have a good view at all, especially the next 3 years. And I think you get aftershocks for 3 years after that before some of the key demographics turn up again. So I think the next 3 to 6 years is going to be very difficult, period. I don't see any way around it. No bridge over troubled water.
Okay, Harry, so we've got a huge mosh pit there of negativity, which I totally understand where you're coming from.
I used to be the most bullish guy on the block, so I'm not a bearish guy.
Yeah. So in that case, Harry, what are your thinkings on the dollar and gold?
Okay, the dollar's going to go up, I think, to at least 120, and again, that's enough to take the euro down in the 80s. I think the euro and the dollar long term should be at parity, because I've traveled the world now for 40 years. The Australian dollar should be at 65 to 70 cents. The Canadian dollar ought to be at 75 cents roughly. You know, all these things are out of kilter. So the dollar goes up and gold goes down. We got people out of gold and silver at the top of the silver market on the day, and we're not usually that good. But silver was testing the last bubble top in 1980, a real setup. And gold peaked a few months later. We got out and said gold's going to crash, especially when it breaks 1525, because it was in a long channel. And then when it hit 1,050, we said, hey, this is overdone. People are overly bearish. We're going to bounce towards 1,400, and then it's going to crash again. The dollar going up is bad for gold. Deflation instead of inflation is bad for gold. And gold's been going down since 2013, because that's when the Japanese really stepped up the QE wars, and inflation fell anyway, and the gold bugs finally had to throw in the towel. They've been waiting for rising inflation and even hyperinflation, and you're not going to get it because the fundamental trend, debt deleveraging, financial asset bubble leveraging, destroying money and credit, which is deflationary. Gold correlates, whether you go back hundreds of years or the last decades, it correlates incredibly well with inflation. That's it. And it correlates with the 30-year commodity cycle that peaked between 2008 and 2011. Those are the two things it correlates. It's not a deflation hedge, and it's not even a crisis hedge, because our worst crisis that we've seen in a long time was 2008 and 9, and gold went running to mommy. It dropped 33%, and silver dropped 50% in the second half of 2008. It was the U.S. dollar and the highest quality sovereign and corporate bonds that were the safe haven. That's what I'm telling people to go now. Wait this out. And when bubbles crash, then you can start buying commodities, and especially emerging markets will do well in the next boom. Developed countries are going to continue to slow for most, and we won't see a boom. The next global boom will not be like 1983 to 2007 for the developed countries, but it will be like that for emerging countries, especially the next big one, India. India has great demographics, is underinvested, under infrastructure. China is overinvested, overvalued, and their demographics have been declining since 2011. Declining, the only emerging country in the world, and everybody thinks China is going to take over the world like they thought Japan would in the late 80s, and they were wrong then. I think they're going to be wrong now.
Do you think China are waiting for a bottom in gold to buy more? Because they've been buying that up like hotcakes, putting on that hedge, versus the yields in the US dollar. Yohay, have you got any final words? Because we're going to start wrapping this up now. What's your outlook for 2017 and a little bit further into 2018, just on a broad scale?
Well, 2018 is too far for me on my horizon, but I would say that in early we're going to see probably the current trends extend. That means a stronger dollar, at least at the beginning of the year, probably throughout the first quarter, maybe a bit in the second quarter. But then I think, as I see it, markets have overreacted to Trump, and without the real fiscal stimulus, we're going to see the dollar retreat a bit, a natural correction. So I don't see our dollar reaching, at least not in 2017, the 80 level. I think we could challenge parity, though, at the beginning of the year. Europe, well, the euro is going to, I guess, will bounce afterwards, but will not go anywhere fast. UK is going to be a bit more in trouble after the official announcement of Brexit. Things might get worse. They're already beginning to get worse. So far, the UK skipped the worst of the Brexit. Regarding Japan, I think 115 to 125 is going to be the range. Japan will not like to have such a weak currency that'll grab attention. Trump wants to, label China as a currency manipulator. Japan will not like to be under the radar as well. So I focus on currencies. So these are the main currencies. So I see a stronger dollar at the beginning of the year. And then it's too hard to predict with politics. I believe there will be some kind of a correction, but there are really so many political factors. So let's talk again in June, I guess.
Okay, well, thank you very, very much, guys. We've got another panel of experts joining us very shortly. We're going to be talking about the markets on a more technical basis and less fundamentally. But Harry, thank you very much for joining us today. That was very, very insightful, and I will be getting.
Fascinating.
You want to tell our audience how we could get hold of your latest book? Maybe
yeah. You go to Harry. I mean, the publisher's coming out with early January. But we have books we've been using for our subscribers and marketing. You go to harrydent.com, and people in the United States or Canada can get a free book just for this shipping, advance of the publication. And we also have a free daily newsletter called Economy and Markets, which you can just put in your email and get on that for free and get to know us better. So that's the best way, harrydent.com. Okay, there we have it, guys. Well, thank you very much. And Harry, I hope we'll have you again shortly. And Yohay, I'll see you in a few minutes for the next panel.
Thank you very much. It was fascinating. Thank you.
Thanks, guys. And have a good Christmas.
Okay.
Thank you. Bye-bye.